Okay, I've got 4:30. Welcome, everybody. Welcome to Market Insights 2026. I don't want to ever hear from anyone that this team is not flexible because we've had to be very flexible today. Our Wi-Fi is actually down, so we've found a workaround, and we're planning to do this in our conference room area in my office with brand new mic setup that we had put together. And unfortunately, that was not working because the Wi-Fi is down. And so the beloved folks at MediaCom will be stopping out tomorrow. So anyway, we have a cozy little room here that Will and I will be presenting from today. And I've been doing the Insights piece and the Insights presentation since we opened PrairieFire 6-7 years ago. And the important thing, the reason that I always do it is just because things are always changing so rapidly now in the world. And it's always good to hear what has happened, certainly to recap what happened in a prior year, but also then to take a look at what may be coming this year. We're not big on predictions, but we do have opinions about where things might go from here. And I'd like to always present those, let you know what we're thinking, what that might mean for portfolio adjustments, what it might mean for financial planning as we move into the new year, and then just the general landscape. So we know there are always going to be what could be a range of outcomes, and are we ready for those? And what might some of those be on the fringes as well as the mainstream thinking as we move into this year? So we digest a lot of material before we come to this. We look at a number of firms like JP Morgan and Goldman Sachs, the big banks, but we also look at small companies like Berigny and Scharf and a number of other resources that we've been using for years, people that I trust that always have good opinions, sometimes contrarian opinions, which are also always appreciated. So a lot of information is gathered to put this together and develop these opinions. And then we're going to do it a little different this year in our format that Will and I are going to work through a point counterpoint. So what we're going to do is essentially offer up a topic, and then one of us will be in favor of that topic doing well this year, and one will give us a contrary view of why things might work differently than expected or what the market pundits are all saying. So we've taken a few of the topics like inflation, interest rates in the economy, U.S. stocks, international stocks, volatility, and the ups and downs that could come from the volatility that might happen this year, and then just a couple bonuses on bonds and gold we want to talk about at the end. So with all that, before we get going, I want to just kind of recap last year. We had another year in 2025 that was very similar actually to 2024. When we started the year, my insight was pretty much that I thought we would have kind of a choppy sideways year was my expectation. The reason is the valuations had been pretty high in the stock market, and we hadn't seen a recession, but there were some indications that maybe one was coming. And the pressure around artificial intelligence and that sector continuing to perform very well seemed like there was limited upside. That's not what happened. We had a little bit of a tantrum in April where we saw the tariff issue really come front and center, a lot of concerns about what that was going to do to the global marketplace. And we learned a good lesson from whenever there's a policy error made in Washington, said policy can be reversed. And all of a sudden we can be looking at a whole different landscape. And that's what happened. I wouldn't compare it to COVID because that wasn't really a policy error. That was a real tragic pandemic. But we did see the market recover quickly. And we saw the same kind of behavior in April where the market did recover very quickly and tended to prove the point that when you have an upset like that, you want to stay patient because you never know what's going to be on the other side of it. And so in 2025, we did see the artificial intelligence boom continue to grow. NVIDIA has become one of the world's largest companies, if not the largest company in the world. And when I was looking back to markets of the 80s, we talked a lot about energy companies and banks being the lead and where the markets were concentrated. Now it's all in technology, growth and development, artificial intelligence, the build out of data centers, and all the things that are going on downstream from all of that as these companies are being developed. Interest rates come down a little bit last year, maybe a little bit less than we expected, but they were lowered throughout the year. And at the same time, the economy was performing well. We usually see interest rates go down when the economy isn't doing well as a stimulus, but that's not what we saw in 2026. So we've got some opinions about that as we move into the new year as well. With all of that being said, let's kick off our look at 2026 and what's to come. All right, so we're going to talk first about inflation. And if you've done reviews with us in the last year, we've used this slide a lot to talk about, Will in particular, talk about inflation. So tell me, what's your opinion as we move into the new year here, Will? What are we going to see with inflation?
My opinion is I think the worst is behind us. You can see that in the middle of the chart there. It's 2022 when inflation peaked at just over 9%. But back then, energy was a major contributor, and that's showed in the green there. But as we've moved past that into last year and this year, we've been hanging around this mid 2 to upper 2 range. We briefly, I believe, touched 3%, but mainly in the mid to upper 2s. And I think, again, like I said, the worst is behind us. I think we're going to hang around in this area a little bit longer. And I know, Matt, you'll speak on that in a second, but there's just multiple things that are going to keep it in this upper 2 range, especially as we're cutting interest rates. I don't think we're going to hit the 2% target quite yet.
All right. And my counterpoint is that inflation, I believe, is going to be sticky and continue to potentially go up. We still haven't seen all the impact of tariffs and what's going on there and how those are going to impact the price of consumer goods. We are still seeing inflation, and I hear it from all of you that you're seeing prices go up with your insurance, prices going up at the grocery store. If you're buying a car, I've heard prices are continuing to inflate. So I'm more inclined to think that we could see inflation either stay where it is and or go slightly up like it was beginning to do in the latter part of 2025. As that all filters through, it'll be interesting to see. So we're also seeing a disconnect between Wall Street and Main Street. And this was a point that JP Morgan brought up that I thought was very interesting, where if you're an investor, you've been feeling good the last 3 years. If you're waiting for your salary to go up as a Main Street employee, however, you're not feeling a lot of joy because the prices of things have gone up way more than what wages have gone up. And so Main Street's feeling blue and they're feeling down, and Wall Street is feeling good. That disconnect means that lower end consumer, or the people that are working throughout the bulk of what we call the middle class in America, are not spending money. And our economy grows from all of that. That's why I think if things begin to move the other direction, we could see prices continue to go up. And as that disconnect grows, it could also create more inflationary pressure because we're having to raise prices to keep economic growth going. And the middle class just isn't supporting those higher prices. So it'll be interesting to see what happens there. Our most likely outcome, probably moderation, where somewhere in the middle of what Will and I think is probably what we'll see. But like I said, don't do predictions, but time will tell. Inflation is going to be a big story, I do believe, throughout the year, as it has been. All right, you ready to move on?
I'm ready.
Rock and roll. Okay, interest rates in the Fed. Can they sink the putt? We're only a few months away from the Masters, everybody. Hard to believe when it's going to be, 600 below this weekend?
Yep.
I think we're going to be in Iowa, what they call absolute zero, where you have the absolute absence of heat in any way, shape, or form is coming to give us our typical January slap down. So anyway, let's talk about interest rate. Will, what's your position on these?
They cut rates a couple times last year in 2025. And in my opinion, or my consensus, is probably steady from here for a little bit. Let the economy itself work itself out. Maybe a 1 or 2 rate cuts, but nothing crazy. And that's just because the economy has been pretty stable. I know some consumers are being a little choosy on what they're buying, but they're still spending money. And that's what's keeping the economy going. I do think, though, as we move into the spring here and once we get through tax season, when people get tax refunds, first of all, they're projected to be larger than usual this year. But when people get that money, they spend it, and they spend it quick. And so there could be a temporary boost for the economy in the spring and summer as people spend those checks.
All right. So you're calling for stable growth.
Stable growth and probably stable rates, maybe 1 or 2 cuts.
Okay. All right. I think rather than stable growth, we're going to see either growth moderate or even come down a little bit. And so when you look at this chart, if you look at the green on here for market expectations, the market's actually expecting rates to go up a little bit. And so I think, contrary to Will's view, that we could see, if there is inflation, interest rates coming up, and if the economy gets heated at all. So all these tax refunds, $150 billion, is that kind of the number we've been hearing that could be going into the economy, getting that money getting spent fast? That goes back to our prior argument that inflation could go up then if everybody's out buying and paying more for goods. And so I do think the market is overestimating lower rates. I think that it believes that rates are going to keep going down, but however, we've not seen that come to fruition. And what the Fed's going to do next, we're going to have a new chairman. It sounds like it's going to become political, even though they say they're not a political body. It's inevitable anymore in all government institutions, it seems. So I do think we're going to see that growth picture moderate a little bit. And consumer confidence is low right now. If you look at charts on where consumer confidence is and their ability, feeling good about their job, their outlook, their ability to spend money, it's low. It could be that Will's caveat with the tax refunds, that'll change that. But as I see it right now, I do think growth could be relatively stable or low this year and potentially not go into a recession, but get us closer to that pre-recessionary pressure. So we'll see. Somewhere in the middle is like where we're going to land on this one too. All right, Will, the stock market. I tell you what, you talk about the gift that just keeps on giving.
That is true.
All right. I'm gonna be kicking this one off because Will could talk a little bit about the concerns, but market momentum right now continues to be very strong. We're seeing huge amounts of money being spent and earned on artificial intelligence, and there's no end in sight to that trend at the moment. There are concerns about where energy might flag on this because there's not enough energy to support where the AI infrastructure build out is going. However, there are plenty of parts of the market, mid caps, smaller companies. We'll talk next about international areas. There are parts of the market that are fairly priced. So even though we're seeing higher valuations than we've seen in the past, a lot of that is due to the fact that we're top heavy. So I still believe that the U.S. is a dominant player in the equity and stock markets, that the trend of the last 3 years is going to continue, and that we could see a relatively good year. Will, what do you think?
I'll be the Debbie Downer on this one, as even though in my short career, the market's been pretty much nothing but up, but like
maybe you're the secret. Since you joined the business, the market is like a few bad days that we've had. I've seen your face in a complete panic in my office. You should be ready for more of that in your future, just so you know.
But like Matt said, valuations are high, and a lot of that has to do with artificial intelligence. You just have to pay a lot more for stocks than you did in previous years. And as long as companies are earning enough money and to justify their stock price, that's great. But if there's one hiccup and all these stock prices are this expensive, we could see a decent sized pullback to bring some of these AI companies back to reality a little bit. But I also do agree with Matt that there are other areas of the market outside of just the mega AI players that are a little more downstream that definitely have some legs to run. But as the top part of the market sits, it's definitely overvalued a little bit.
Okay, fair enough. We'll see. All right, let's talk about international stocks. So for many years, even going back to when I was at Morgan Stanley, there was talk that, boy, the valuations, the prices of international stocks are way below the U.S. And at some point, that's going to correct, and we're going to see those come more in line. This is a chart from last year, the MSCI EAFE. God, we love our abbreviations in this business. That is the international stock index. So developed markets, think Europe, think Japan primarily. And so those developed markets, you can see were up over 31% last year compared to the U.S. stock market, which measured by the top 500 companies was up about 17. So very interesting dynamic. For the first time in a long time, it broke away. And you can see early in the year is when it broke off. It did follow the tariff tantrum, but it stayed up then for the rest of the year. And I thought this was mostly due to the dollar, but I believe we're entering a new dawn of international opportunities. And it took me a while to come to this belief. I didn't see it early on. I thought just a dollar disruption wasn't enough. But what we're seeing is a trend of nations becoming much more self-reliant. The Russia-Ukraine war is a big impetus in this for Europe because they got so much energy from Russia. And that had to stop because they'd invaded a NATO or an ally. And so that dynamic could very much continue where people are beginning to create their own energy, get their own resources, do their own manufacturing, make sure that important goods like drugs are made in-house, in-country, so that they don't have to rely on a Russia or a China in the future. And the tariff thing, all of that, I think, plays into this as well. But I think countries are getting stronger on their own, which means their companies will get stronger and get more support from their governments. So I do think we're entering a new dawn and a new era where we could really see international investments do well. All right, for our counterpoint, Will, what do you think?
I think there's opportunity here. I think we still need to be careful, and that's just because of all of the geopolitics over there. It seems like there's a new skirmish or there's new tension pretty much every week with all the different countries over there. So I think it's still important to be careful and not maybe go all in just yet. This was the first year in a long time that they outperformed. Want to see how they continue to transition and continue to onshore more of the manufacturing and stuff that Matt just mentioned. So definitely I'm going to proceed with caution on this one.
Yeah. All right. Too early to say, I think, is the verdict on these. All right. Rough seas or Gray's Lake. Gray's Lake today is frozen over, so definitely not seeing a lot of volatility in that sea. However, on some windy days like yesterday, if there was no ice, we would have seen a lot of volatility out there. But when we talk about volatility, what we're mentioning is with the ups and downs of the markets. And when we look back to April, that would be a volatile period. And so volatility is measured, and there's measurements that you can see it going up and down. It's almost always going up when the market is going down, where you're seeing a lot of trading, a lot of people being concerned, selling in a panic, all those kind of things. Will, why don't you kick us off here on volatility? How do you see this shaping up this year?
Volatility can be a little bit scary at times, but as a long-term investor, it definitely presents opportunity. I just think back to April of last year when all the tariffs and stuff got announced and the market did not like that and went into a downward spiral. But then I remember it was a Wednesday and I think we were in a meeting and the market was just going down like normal. And then got out of that meeting, checked what the market was doing, and the NASDAQ was up like 10 or 11% like that. And I was like, that can't be right. But it was. And it's because one of the initial pauses with China, I think, was announced. And so the market like that shot back up. And so if you would have panicked and sold at the bottom, you would have missed that super quick recovery. So definitely buying opportunities in volatility because it can be short-lived.
It's more difficult to deal with volatility now because of the news cycle in the media. No question that their input into markets, and when the news comes across on Twitter or wherever people get their news, the markets react quickly. In that season, I remember everybody was reacting to every little piece of news in the market. Generally, the market's a sorting machine. It sees what's happening out 6 to 9 months, but it can get very panicky. And there's a lot of reasons for that. There's electronic trading that says if the stock gets to a certain price, it has to be sold. For a hedge fund, for instance, or an institution, a lot of retail buyers will panic in the midst of these, both buying and selling. People will get overly aggressive or overly conservative when these moves come along. So we're all still human, and those human dynamics still show up in the markets a lot. And we saw that in Europe. So I do believe these behavioral challenges will always be an issue. A 10% correction in the market is incredibly normal. It never feels good, though. And now when the Dow is almost 50,000 points, 10% corrections, 5,000 points, man, that's going to get your attention. We're not used to these bigger numbers in the markets. And just prepare yourself for what could be, I believe, as a counterpoint, a pretty choppy year. And I believe that because we are stretched in our valuations and we are moving into a midterm election year. And you can see from the history, typically the markets are up in those years. And Marianne Bartels brought up on her presentation for the outlook is that you see it generally a pretty choppy year as the election gets parsed before it actually happens. Then in November, when the verdict is in and we know what's going to happen, we tend to finish the year pretty well. So I wouldn't be surprised to see that kind of dynamic this year. As we move through the summer, polling numbers are coming out. It's looking like it's going to go one way or the other, that the market behaves accordingly. But then after it's done, there's a known, and people react generally good. And just as a reminder, the market does love gridlock. So if there is a split in this election to where there can't be a lot of legislative work done the next 24 months, it will actually like that. It's because nothing can get screwed up per se, or nothing can get changed dramatically in tax policy, geopolitical policy change, things like that. So just be on the lookout for all that as we move through the year, and we'll want to be careful to not overreact to any volatility.
And then I just want to add one more piece to that regarding the midterms. There's research was done by Capital Group that in a year following a midterm election, the market actually does pretty well on average, about 15%. Like Matt said, once the election it has been decided, it's over, tend to finish strong, and then you continue that momentum into the new year. And all the way back to the 1950s, a year after a midterm, market tends to do about 15%. Obviously, a look at the past does not tell you what the future is going to do, but just an interesting tidbit there.
What word is it that we don't use?
G word. I'm not even going to say it.
All right. We've tried to open up the chat. If you have any questions, please lob them in there. I'll keep that open. And then I wanted to talk a little bit about bonds and a little bit about gold. We had a good year in the bond market because rates came down. So just as a reminder, when rates go down, bond prices go up. So if you own bond funds, bond ETFs, individual bonds, they all tend to see a good lift there. So municipal bonds held their own. Mortgage-backed securities did very well. Corporate bonds did pretty decent as well. And so if we did see inflation, we did see higher rates for whatever reason this year, you would expect obviously poor performance in the bond market. However, I'm predicting more stability there, where we're going to see yields nowhere near where they were in the 5s on cash, down to probably the 3s. What's the mortgage rate at now?
No, in some states it's just under 6, but 6 or a little over is still the average.
Okay. Mortgages are at what I'll call the new normal rate of that 6, 7, 8%. For years, we could get them below 3 and 4 and even down to 2%. I don't think that's coming back anywhere in the near future. There's no need for that $0, zero interest rate type economy based on what's going on in the markets. And so I think the bonds were going to be a nice safe haven going forward. And I would caution against holding too much cash, because the yields on that are going to be below probably what inflation numbers are going to look like. So keeping in our retirement accounts, shorter term bonds, things that can get us yields above 4, I think are going to be a good spot to park some money this year, rather than just holding it in money markets and cash like we have been the last couple. And then gold has had a run like I haven't seen in the entirety of my career, maybe a little bit in 2008 when it really spiked up then. But a lot of central governments, a lot of foreign governments are buying a lot of gold. There's concerns about being backed by the dollar. As there's a lot of international tension with currencies and with America and with other countries as well. And people see gold also as a safe haven. And so they've really bid up the price of that. These last 2 days since the Venezuela thing, as well as just recent other events, we've the Greenland skirmish, et cetera, we have seen gold really just continue to spike. Silver has gone nuts. And these are our assets. These are investments that are the prototypical buy low, sell high. So you can hold them for a long time as a hedge and a protection, but they tend to move bigger than like bonds do. They're more volatile. So when you do get lift in the price like we've had recently and we had into last year, I've been a proponent of trimming our exposure there and taking those profits and getting our allocation. So if we owned 3% in your account and it goes to 6, you are likely to see us trim that back down to 3 as part of our rebalancing work, because holding it forever, it could keep going up, but we can't put a price to gold to say this is the fair value, because it's just what the market determines that it is. We can't say, like Apple, based on what its earnings and other multiples in tech companies, we can say 250 is the right price for Apple right now. You can't do that with gold. It's just what the market, just like Bitcoin. We can't really say that 100,000 a coin is the right number for Bitcoin. So gold behaves like that a little bit. So just a word of caution, and also a celebratory, hey, we've finally seen some nice growth in an investment that we've held for a long time here at PrairieFire for a lot of our clients. So that's the deal there. All right. Not seeing any questions. Anything come across your desk lately of interest, questions that you got for clients that you want to talk about?
Not really. I think we covered pretty much all of it. Just feel like the biggest thing at front of mind for people is inflation and volatility, and we covered both of those.
Okay. Good deal. Thank you all for joining us today. We will record this and have a replay available if you're interested, or if you'd like to share it. And if you do have questions that you weren't able to ask today, I hope you'll send them over to us and share those. Let's see, I've got, most of you know us, know where to find us. And if you do stop by, we got brand new glass doors put in the office. They look really cool. So we've got our own little vestibule now. And so PrairieFire is settled in on Fluor Drive. Anyway, thank you all for joining us, and we hope you have a wonderful new year. We're here to help in whatever way that we ever can. So thanks again for joining us. We'll see you later. Bye-bye.